Jeremy Grantham, a renowned British investor with over US $118 billion in assets under management as of March 2015, holds a remarkably incisive view regarding the American market in recent months. He has been unequivocal in advising against investing in the United States. In this video, you will grasp the reasoning behind this statement and why many discuss an imminent market crash, including a recession akin to that of 1929, according to Grantham. The events of 2021 marked a critical point in the global markets, especially within the realm of tech stocks, which revealed themselves as deflationary forces of unpredictable proportions. This phenomenon brought with it a domino effect, influencing not only the technological sector, but reverberating throughout the financial market. The collapse of tech stocks in 2021 triggered a chain of events that echoed as a silent warning to investors. Companies that were previously considered solid pillars of the market showed unexpected vulnerabilities. The overvaluation, often detached from the financial reality of companies, proved to be a bubble ready to burst. The magnitude of these bankruptcies extended beyond the technological sector, affecting the overall confidence of investors. The market, known for its volatility, was shaken by this unexpected breakdown, creating an atmosphere of widespread uncertainty. Investors began to question not only the solidity of technology companies, but also the stability of other sectors. Grantham has long warned about the overvaluation in the stock market, especially in the technology sectors. His anticipatory view of the slowdown in tech stocks in 2021 took on even darker contours than he had foreseen. The collapse of these companies was a direct reflection of the risks he repeatedly pointed out. For investors, especially those involved with tech stocks, this breakdown represented a harsh blow. Many saw their portfolios shrink rapidly while trying to understand how seemingly robust companies could collapse so dramatically. The psychological impact was significant, undermining confidence in the market. The focus on the American economy reveals a paradoxical panorama. Amid indications of low inflation, apparently stable conditions in the labor market, and a noticeable increase in consumer spending during certain periods, the shadow of a possible recession in the United States looms. Macroeconomic indicators, at first glance, present themselves as pillars of a robust economy. However, Grantham highlights the market's tendency to become excessively optimistic in the face of brief periods of stability, confusing these moments with unequivocal signals of a bullish market. The market's excessive confidence can create an illusion of stability, leading investors to disregard warning signs that could herald an imminent recession. The apparent confidence becomes a smokescreen that obscures the real risks. Grantham not only questions this exaggerated confidence, but also warns about the market's propensity to ignore underlying risks. His in-depth analysis points to the possibility of a prolonged recession based on economic fundamentals often overlooked by those who see only optimism. Market complacency is fertile ground for blindness to risks. Even after the temporary avoidance of a government shutdown in the U.S., the risks of a recession persist. Grantham highlights history as a guide, warning of the dangers of underestimating warning signs. This unfounded confidence can leave investors defenseless in the face of imminent events. Excessive optimism often results in a devastating chain reaction when true risk signals become evident. The analysis of the erratic market attention in the United States offers a valuable lesson about the need to look beyond the surface. Apparent optimism can be a trap, obscuring signs of a possible recession and underestimating the complexity of financial markets. The analysis of the yield curve, especially when inverted, proves to be a key indicator in predicting economic recessions. This metric, highlighted by the Federal Reserve of New York, is one of the most concerning signals on Grantham's and financial market observers' radar. The inversion of the yield curve occurs when short-term interest rates rise above long-term interest rates. This phenomenon may suggest a negative economic growth outlook. creating an atmosphere of uncertainty and concern among investors and analysts. The Federal Reserve of New York warns that, according to its model, there is a significant probability of a recession in the next 12 months, reaching almost 70%. This forecast, above historical statistics, raises red flags about economic health and the imminence of a recession. The interpretation of the inverted curve points to a scenario where short-term interest rates exceed long-term ones, a phenomenon that historically preceded recessions. This inversion is interpreted as an indicator of economic imbalance and can be a harbinger of economic difficulties ahead. Grantham not only observes this indicator closely, but also warns about the underlying dangers of the yield curve inversion. The scenario of complacency on Wall Street and the potential failure in Federal Reserve predictions bring to light the increasing risks permeating the financial market. Grantham highlights these dangers, warning of signals of an imminent recession that might be underestimated. Complacency on Wall Street is a recurring narrative that unfolds in moments preceding major market upheavals. Excessive confidence and the inability to recognize historical warning signs are striking characteristics of this environment. Grantham doesn't spare criticism of the reliability of Federal Reserve predictions. He highlights the Fed's failure to anticipate and react to the consequences of major economic bubbles, emphasizing how these predictions can mislead investors and the market in general. Complacency in the face of imminent risks can create a false sense of security among investors. The market, often overly optimistic, may overlook warning signs and concerning indicators, resulting in decisions that do not adequately reflect potential dangers. The analysis of Wall Street's complacency and Federal Reserve predictions urges us to consider the importance of a critical and cautious approach to financial market forecasts and behaviors. This awareness can be crucial for investors seeking to make informed decisions in a scenario of increasing economic uncertainty. The evident vulnerability in the stock market and the risks associated with economic bubble formation become areas of concern, especially when considered in light of Grantham's warnings about possible disastrous outcomes. The underlying fragility in the stock market is a concerning sign that cannot be ignored. Excessive dependence on certain sectors or the overvaluation of assets represents fertile ground for bubble formation, increasing volatility and risks for investors. Grantham has long drawn attention to the dangers of economic bubbles. His incisive warnings about asset overvaluation, especially after periods of rapid appreciation, highlight the market's vulnerability to a possible severe correction. Market exuberance, often fueled by overly optimistic investments, can create a false sense of confidence. This excessively positive sentiment can obscure real risks and lead to decisions that ignore underlying weaknesses. The formation of economic bubbles brings serious implications for the market. The bursting of a bubble can result in substantial losses for investors, financial instability, and a significant impact on the global economy, emphasizing the importance of paying attention to warning signals. The analysis of market vulnerability and the dangers associated with economic bubbles prompts us to consider the importance of moderation and caution in investments. Grantham's warnings offer valuable lessons about the need for a prudent approach to avoid market excesses. Grantham warns about a possible recession in the U.S., but there's something even more impactful. Michael Burry, a renowned investor, bet against the market in 2023. Watch Burry's video to better understand. His bet indicates something significant. Stay informed and prepared to act in the face of possible market changes. Be a step ahead and anticipate opportunities and challenges that may arise this year.